Adobe stock has been getting hammered over the past year, down 27%. Now, as someone who actually uses Adobe products every day, whether it's Acrobat, Photoshop, Lightroom, or Premiere Pro, I've always admired how powerful their ecosystem is. So seeing a company with this level of brand strength and loyal users trading at these lows honestly caught me off guard. So in today's video, I'm putting on my CPA hat and digging into Adobe's financials, growth prospects, and valuation to figure out one thing. Is Adobe a screaming buy right now, or is it a classic value trap? So let's dive right in. The main reason Adobe stock has been sliding is AI. The market's worried that Adobe is falling behind its peers in the AI race, and that's as generative AI gets better. Tools like Photoshop might lose their edge, but here's the thing. I've personally tested a lot of these AI tools for photo editing and color grading when it comes to videos, and honestly, the results just don't compare. The control, precision, and creative touch you get with Adobe Suite is still miles ahead. So while AI might look like a threat on paper, winning over dedicated Adobe users won't be that easy. Now jumping over to Adobe's financials, revenue over the last 12 months came in at $23.2 billion, and it's been growing consistently over the past decade at a solid 13.3% compounded annual rate. Gross profit sits at $20.7 billion. So at this point, you're probably wondering, what's the market seeing that we're not? Because based on these fundamentals, the sell-off doesn't quite add up. In my view, the disconnect between strong financial performance and weak stock price could present a real buying opportunity. Looking at profitability, EBITDA over the past 12 months is $9.3 billion. So not only is Adobe expanding its top line, but it's also improving its bottom line, a combination that you don't see too often in this market. Moving on to valuation, this is where my conviction really starts to build. Adobe is currently trading at a PE ratio of just 22.1, which is well below its 10-year average of 50.8. That's roughly a 56% discount based on historical earnings multiples. And if we look at their price to sales ratio, the stock's sitting around 6.4 compared to its 10-year average of 12.8. That's about a 50% discount. So by almost any traditional metric, Adobe is trading at a steep discount to its historical valuation. And for a company that's still posting double-digit growth, that's pretty rare to see. Now, don't get me wrong, but the threat of AI impacting their business exists. But does it exist to the extent that their valuation drops by 50%? I don't think so. Looking at this chart alone, it's clear what's happening. Revenues are climbing, gross margins remain incredibly strong for their business model at 89.1%, yet the stock price keeps trending lower. To me, that signals one thing: the market is overreacting. According to analyst estimates, the average price target for Adobe is $454.18 a share, compared to the current price of just $354.12. That's roughly a 28% upside from here. And keep in mind, that's just after big institutions like Morgan Stanley trimmed their target from $520 down to $450 just to stay conservative. Now, even with those adjustments, the majority of analysts still rate Adobe as a buy, and I'm right there with them. The fundamentals are intact, the business is executing, and the market's reacting to fears that may never fully materialize. And even if they do, I don't see them impacting Adobe anywhere near the scale investors are pricing in right now. So friends, if you enjoyed the video, drop a thumbs up and subscribe to the channel. Let me know your thoughts on Adobe in the comments below, and as always, thanks for watching. I'll see you in the next one.